Hello and good morning, listeners. Welcome back to Almus Market Mornings after the weekend, your daily dose of global financial update with me, Shikhar Garg. And what an eventful weekend that we have had over here. I mean, India losing out to Pakistan in the Asia Cup match was some sort of a distinct, but at the same time, we have much bigger reasons to worry for when it comes to global economy, losing out to the power and the ego struggle globally. Yes, geopolitics looks to add furthermore woes as Russia announces on Friday that it would no longer supply through Nord Stream 1 pipeline. Now, possibly this can lead to a sharper rise in energy prices, to which the Nordic states were seen announcing emergency financial liquidity measures for the energy generators. On the other hand, US plans to sell USD $1.1 billion of weapons to Taiwan as the country's defense comes under increasing military pressure from China. So, geopolitics has its own kind of ways going about in the financial markets. JK, we need further updates from you on how to move about with this kind of tensions simmering and impacting all the currencies as well as the financial markets.
Yeah, thank you. Thank you, Shikhar. Actually, we went to the Friday New York session, all focus on non-farm payroll report. And the report turned out to be kind of Goldilocks report in the sense job creation was slightly better than expected. At the same time, unemployment rate was rising. And the wage inflation has moderated to 0.3%. This is just what the market would have hoped to see. And in fact, the reaction immediately was to sell the dollar and buy stocks. S&P 500 was up at 1.3% at one point of time, and yields also fell moderately. Again, people looking at what Fed do in September, whether 50, 75. But then, since then, we've been hit by a host of geopolitical and oil-related news, which has really put the markets back on, against the wall. And the mainly the US market slumped in a big way. The losing out, not just lost out the gains, but also ended quite a bit in the red once again because the Russia stopped their gas supply totally to Europe, citing technical glitches in the supply to the Nord Stream route. So that actually before that, in fact, European markets had ended deeply in the green with gains over 2%. But I mean, the subsequent developments obviously, we'll see them drop today. And that was one trigger. And even the Treasury Secretary, former Treasury Secretary Summers' statement saying that unemployment rate may need to surpass 6% from 3.7 reported this month in order for Federal Reserve to bring inflation back to 2%, even think about cutting rates or something like that. So he's actually surprised that market is taking these small rises in unemployment rate as a good news. So Summers has been having good perspective, which I have been personally following ever since the inflation story started, and he had this view that inflation will go to high levels of 80s and all that. So I think one needs to give value to his statements. On a different page, the US President Biden also poured cold water on expectations that US may ease or remove the Trump-era tariffs on China. In fact, they have clearly stated that they will allow the tariffs on China to continue. So no wonder that China market is once again under stress, and the Chinese one made a new low today above 6.04, that new low in this cycle, of course. Obviously, euro has had a bigger hit, almost breaking 0.99, which has been holding for several days now. And the triggers is that even we have other triggers on the geopolitical side, that the NATO decided to put a cap on the oil price which is being imported from Russia. So that again, we do not know the effectiveness, how far it will be effective, but definitely it is actually triggering more reactions from China. I don't know what they will be up to in the next, stage. Also, there is news that, the Iran nuclear deal is once again getting stalled. A lot of expectation is pinned around this event, but that's not happening in a hurry. Israel seems to be objecting to a lot of clauses, and also the fact that they don't trust Iran to uh, you know uh, honor the commitments. And we also have OPEC meeting coming up this week, which will keep the oil supplies tight because they feel this demand is easing. Therefore, there is a chance that they will cut some part of the production now that the oil prices are also lower. So there's a lot of things that is related to oil and geopolitics that has kept the risk sentiment below par, even in the Asian market. Not a big slide, of course, but definitely it is reflected in lower stock prices and, of course, a stronger dollar. Dollar hit a new high above 110 today. As I said, euro tested below 0.99. Dollar yen new high at 140.70. It was seen. Right now it's slightly down. GBP at 1.1450 was seen, but that's just a whisker away from the pandemic low of 1.1407. Commodity currencies, of course, continue to be under pressure because of the slowdown in China and also global recession that is on the cards. So all in all, we are starting the week with a lot of challenges for the risk assets. We also have a good schedule this week, starting with the central bank meeting of Reserve Bank of Australia, then Bank of Canada, and to the all important ECB meeting on Thursday, where now there are 80% chances that they will hike rate by 0.75%. And of course, one does not know the ECB's intentions, because the economy is definitely going to slip into recession with all the challenges on the energy front. But whether they will really go with 0.75, that is something that we need to speculate. On the dollar rupee front, of course, we are closer to the resistance at 80. Once again, we currently indicated 79.80, and might be some lesser demand today because US is closed, so there will be no outward remittance demand. But then spot demand and the forward delivery demand can remain. So fundamentally, the India's trade deficit as well was higher. In the sense, it was lower than last month, but definitely higher than the average seen in the last 6 to 8 months at 28 billion. Export was slightly lower and import picking up hugely because of oil price. Also blamed on stocking up of coal and petroleum products, citing energy security reasons. So they're claiming it to be a one-off and may moderate in the coming days. But definitely at 28 billion a month, it's a concern how long RBI will defend the rupee when the deficits are running at this rate. CAD being indicated at 3.3% for the full year. Also, we had the RBI reserves falling by another 3 billion last, previous week. Now we are down to the level where we were in December 2020. As far as the reserves are concerned, we had lost exactly 80 billion from the peak of 642. So where is the line that RBI is going to draw if dollar continues to be under upward pressure? That is the question in my mind. So we start the week with poor risk sentiment, dollar strong, and rupee question mark whether we still break 80 or not. Thank you.
Okay, it's a wonderful question to everyone out there. We are still seeing whether USD INR will break 80 or the central bank will come in to rescue again when it comes to the 80 handle. But yes, we do begin the week with good risk of sentiment, citing all the sorts of geopolitical tensions we are seeing, as well as the macro updates that we are receiving. I mean, India's trade deficit continues to be high, while we are also seeing the unemployment requirements, as the central bankers and the economists say, that we need to surpass 6% kind of unemployment. That's like what we have seen during the Volcker regime. We need some pain to move out of the already existing macro concerns. It's kind of a difficult situation in the financial markets, folks, right now. So let's see how the central banks and the government steer about all these things. Meanwhile, I'd like to highlight one more thing. There is no outward remittances for the day, as we have a US holiday today. So if any transactions planned, we'll have to do it tomorrow. That's it for today, folks. We'll come back again tomorrow morning with another round of fresh updates. Thank you.